You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Dana Peterson, Center Leader of the Economy, Strategy, and Finance Center at the Conference Board, and guest host of today's episode. Joining me today is Stephanie Guichard, Senior Economist of Global Indicators. In today's conversation, we'll discuss the latest U.S. Consumer Confidence Index, as well as consumer payments and student loans. Welcome, Stephanie.
Hi, nice to be here.
And it's always great having you. So let's start off with the first question. How are consumers feeling in August? And how do this month's results compare to the last few months?
In August, it would be fair to say that consumers are feeling the same as they were feeling in July, June, and May. So they had this surge in optimism at the end of last year. Then they became a bit more concerned. April was the trough. Confidence recovered in May, but to a level that was lower than it was at the beginning of the year. And it's been stuck there for the past 4 months. So they are feeling, I would say they are feeling okay, but not so much better or worse than in the previous 3-4 months.
So are consumers still concerned about tariffs?
Yes, very much. When every month we ask consumers what is driving your view of the economy, and tariff is still number one. It has been number one since April, and it's still there. And we saw a slight uptick in references to tariff in August. But this is closely followed by inflation. So tariffs and inflation, which, as we all know, are linked to each other, are the top concern for consumers, far from much higher than everything else in the economy.
Thank you. So have consumers' inflation expectations changed at all?
So they ticked up a little bit in August. So they are now at 6.2%, which is an increase from 5.7% in July. We are still below the peak that we saw in April, where everyone started to really worry about tariff and consumers were expecting to see high prices for everything they buy immediately. Then they realized, no, it's not coming so fast. So we had the decline in inflation expectations, and now it's creeping up again because I guess they see that some prices are higher than they were last year, especially for imported goods.
Let's dive into the details of consumer confidence. What affected consumers' assessments of the present situation?
So overall, consumer assessment of the present situation declined slightly. And this was driven by two opposite phenomena. On the one hand, consumers were more positive about current business condition. However, this was more than offset by consumers getting a bit less positive about the current labor market. And in fact, we've been seeing a deterioration of consumers' assessment of the labor market since the beginning of the year. So this was the 8th consecutive month of decline of consumers' appreciation of the labor market.
And what about expectations? What influenced the changes in that measure?
So again, expectation also declined a little bit, and it's interesting to see that there we had the same phenomenon as for the present situation. So we had an uptick in consumers' expectations regarding business conditions. So it's still in negative territory, but a bit less than in July. However, this was more than offset by consumers' view of the labor market going forward, which deteriorated slightly, and also by consumers' views of future income, which, although it remains positive, was also less positive than in July.
Thanks, Stephanie. So here's the big elephant in the room. Are consumers still anticipating a recession within the next 12 months in this survey?
Yeah, so the recession expectation is a new question that we added a few years ago. It's been showing that the majority of consumers have been expecting a recession since 2022. So we are not sure how low or how high this can be. But what we see, and when we focus on the change, we see that compared with July, there was an uptick in the share of consumers expecting a recession. And we really need to focus on the change rather than the level, because otherwise, to show that consumers have been expecting a recession, like a vast majority of consumers have been expecting a recession since 2022. In terms of changes, it went down in the past few months and now it's picking up again.
Thank you. So, what is all this information that we learned today and over the last few months telling us about the second half of the year or the remainder of the second half of this year?
So for the second half of this year, consumers are still very cautious. They are still very much focused on what's happening to prices and how tariffs are going to impact prices. So that's their main concern. So they enter the second half of the year with this in mind, and they're going to be very sensitive to what's happening to prices. We look at their spending intentions, and we saw this month some kind of mixed result. What's interesting, if you look at services, for instance, we see some increase in the plans to spend on non-discretionary services, maintenance for your car, maintenance for your home. At some point, you don't really have the choice. These are not spending that you can push forward. However, we see a decline in discretionary spending, like going to restaurants, going to museums, going to attraction parks. I think it shows that consumers are becoming more cautious about their spending intentions. When we look at goods, we had very mixed results in the month, and which likely reflects the fact that they are looking at how much they're going to pay for something, and then they base their decision really on the prices. So that's going to be the main driver on their spending decision going forward. I think that's the main message of the survey.
Thanks, Stephanie. We're going to take a short break and we'll be right back with more of our conversation.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge, from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. I'm Dana Peterson, Center Leader of the Economy, Strategy, and Finance Center at the Conference Board. Again, I'm joined by Stephanie Guichard, who is our Senior Economist of Global Indicators. So let's jump right back in, Stephanie. Your team has also produced some recent research around consumer payments, meaning what's the first thing that consumers reach for when they're at the cash register, and also student loans and how that's impacting how they feel about the world. So let's start with student loans. What were the top line results of your research about student loans?
So our research on student loans, first it showed that in a sample of consumers, about 20% of consumers still have student loans that they need to service. And it's not only young people, it goes through all the ages and all the income that we are covering. And we asked them how the recent changes on student loans, and especially the end of all the relief on student loans repayment that they got post-pandemic, this is ending, and we asked them how much this is going to affect them. So the big finding is about half of the consumers with student loan thinks that with the change in the regulation and the end of the relief, this is going to affect their ability to spend. So that was one of the most important findings.
Affect their ability to spend in what way?
To spend on goods, to buy the things that they want to buy.
Okay, so it's a negative effect.
That's a negative effect. And then it's not the only negative effect. So as now that if you are not repaying your student loans on time with the end of forbearance, now it's going to be reported in your credit score. And 40% of consumers were indeed concerned that they may be late on student loans and this may affect their credit scores and, as a result, their ability to take new loans. So that's another potentially negative effect. Another
Yes.
potential negative effect is that 39% of consumers were worried that the need now to service their student loans if they don't want to see a decline in their credit scores or if they don't want to be in trouble is going to affect their ability to repay other loans. They may have to choose between which loan they want to repay, which is not a very good situation and which may lead to some of the problems we're seeing on student loans spreading to other segments of the credit market. Overall, consumers are concerned. And the last one is 35% of the consumers who have student loans are aware that there is a chance that if they don't pay, this is going to affect their paycheck through some direct impact of the federal government collecting the money through their paychecks directly.
Yeah, so this has serious implications not only for consumption, but also for consumer credit. And we could see spikes in delinquencies that turned into bankruptcy. So this is something that we should watch very closely. But again, as Stephanie said, it's not just a certain segment. Many different types of people of different ages and incomes have student loans. And if they're not able to service them, then it does cause this kind of domino effect of negative things that happen to their finances. So let's shift over to consumer payments. So again, consumers like to shop. That's why we call them consumers. And it's really curious to know what is the first or second type of payment they reach for and why. So why don't you tell us about that research that your team conducted?
Yeah, so we asked consumers how in the past 3 months they have been paying for the things they buy. And overall, and maybe a bit surprisingly, 87% of consumers are still using cash. Cash has been very resilient to any other form of payments, whether it's credit card, online payments like these e-wallets or buy now, pay later options. Overall, 87% of consumers are still using cash. However, we also asked, what is the type of payment you use the most frequently? And there is the credit card. So they always have cash in their pocket, just in case, and they pay some of their spending with cash. But the most widespread option is using your credit card. And it's still very strong despite the emergence of e-wallets and buy now, pay later options.
So why is cash so resilient?
So
I
there
mean, I
are
always hear about cash is king. It seems like it is.
Yeah, again, it's always a bit surprising when you think that people don't necessarily reach for coins and notes, but rather for their smartphone when they want to pay something. But cash is still there, and there are a few reasons for that. So the first one is we still have a share of the US population that has difficulty to access the banking system and any forms of payment that are related to having a bank account. And what we see is cash is still very predominant for the younger people who are the ones they still don't have a credit history, so they may be more likely to spend in cash. It's the same thing for the very low income. So we have the lower the income bracket, the most likely they are to use cash, not only to pay in general, but to pay for more than 50% of all their purchases. The other thing that I think we all notice is when you use your credit card, depending on where you go, sometimes they add a fee. So I'm just going to give you an anecdote. I was at the farmer's market. I didn't have cash. I wanted to buy something for $10 and surprise, surprise, the final price was $10.75 because I was using my credit card. Businesses charge some fees whenever you pay with your credit card. And then there is a tendency to pass it on the consumers. So consumers who want to avoid those fees, they pay in cash, which is what I'm going to do next time I go to the farmer's market.
Excellent. Talk to us about e-wallets. First, explain what an e-wallet is or an example of one, and whether or not consumers are starting to latch on to that technology.
Yeah, so it's the most recent technology. So it's e-wallets, it's like PayPal or Venmo. So it's associated with, typically you need to have a bank account to be able to have one of these e-wallets, but then they become independent. So with Venmo, you can pay using Venmo, and then you can be paid by your friends using Venmo, and then you're going to keep the money in that e-wallet and you're going to use it for future purchases. So overall, we have 72% of consumers who are using this form of payments, which is quite good. And we also have 27%, so more than one quarter, that are using e-wallets for the majority of their purchases. Of course, this is most used by the younger generation, so about 1/3 of the consumers below 35 are using these as their main source of payment. And then it declines with the age of the consumers. In terms of income, there are no substantial differences. I think it seems that everyone is using it the same way.
Excellent. And this is the last question. Buy now, pay later, or BNPL. This is certainly, since the pandemic, it's become much more popular. So why don't you talk to us about what is it and whether consumers are starting to shift more towards these kind of incremental payments relative to other forms of payments?
Yeah, so buy now, pay later, is the option for consumers to buy something and pay for that purchase in typically 4 installments. Within it could be 1 installment per week. Sometimes they offer you 1 installment per month. It's free credit. It's available when you buy something online, and you see it more and more often. When you buy something online, it gives you the option of spread it into 4 payments, but it's also available in stores depending on where you go. And 31% of the consumers we survey have been using buy now, pay later. And interestingly, 19% are using things for more than half of their purchases. So that's for something that is relatively new, because it really picked up 5 years ago. It shows that how spread it is now and how it has become part of the clear payment options for consumers. I think consumers are very interested in the flexibility they have. You don't have all the money you need to pay something. You can just spread it out over 4 weeks, and then so you can buy something that you wanted to buy right now, even if you don't have the money to buy for it. It's not a form of credit. However, consumers need to be aware that buy now, pay later, if you're late on your payment, first you need to pay interest, but now it's going to be reflected in your credit scores, which was not the case up to recently. So it's still going to be a good option for consumers, but you won't be able to avoid the degrade in your credit score if you don't pay on time. And just if you look at who's using buy now, pay later, it's again more the younger generation. So consumer below 35, we have 1/4 of those consumers using it for more than half of their purchases. In terms of income, it seems to be slightly more used by high income people, but also we have some high usage among the very low income people, because it's another way to access some form of credit, even if you don't have a credit card.
It's like reverse layaway. When I was a kid, layaway was basically you'd pick out whatever clothing you wanted and you'd give it to the store to hold on to until you could pay it off over a certain period of time and get the clothes back. This is allowing you to take those clothes home and then take 4 payments to pay it. So I guess that shows a massive shift from the 1980s when people were willing to wait, and 2025 where people are not willing to wait but still want to be able to have the needs and the luxuries that they can purchase and then pay it off over time without at least a few months of interest. So this is really super interesting, and I'd love to see these dynamics in consumers. So thanks so much, Stephanie, for having this conversation with me today.
Yeah, you're welcome. It was a great conversation.
Absolutely, it always is. And thanks to all of you for listening to C-Suite Perspectives. Again, I'm Dana Peterson, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.